Hello and welcome to a brand new episode of Smart Money. Today we're going to discuss hybrid funds, arbitrage funds, what the funds entail and why you should be looking at them in your portfolio. Our experts today are Dinesh Balachandran, who's the fund manager equity at SBI Mutual Fund, and Bhavesh Jain, who joins me here in the studio. He's the co-head of the hybrid solutions at Edelweiss Mutual Fund. So gentlemen, to both of you, thank you so much for joining us. And this is a very interesting time in the market, considering we're almost at all-time highs and there are several opportunities in the market to look at. So today we're going to talk about the hybrid category. So Bhavesh, let me start with you first for the benefit of our viewers, right? Yep. What are the funds that come under the hybrid category? And then we'll talk about what the opportunities are for retail investors.
Sure. First of all, thanks Sonia for having us here. You can say in the hybrid categories, there are different funds starting from arbitrage fund, then equity saving fund. We have multi-asset allocation fund. We have balance advantage fund. Then we have conservative hybrid and aggressive hybrid fund. So these are, you can say, 6 or 7 funds within the hybrid category.
Okay. Dinesh, welcome to the show. So Bhavesh has listed down all the different types of funds in the hybrid category. But from a retail investor standpoint, where do you see the opportunity now?
Yeah. When you think about it, sometimes it might appear a bit confusing when you have like so many types of funds. But at the core of it, what we are trying to do is essentially have funds that are tailored to an investor risk profile. Now, we all know that equities essentially represent one of the best wealth generation opportunities over the longer term, right? It probably beats every other asset class out there if you have a long enough time horizon. But the problem is many investors get worried when they see these periodic drawdowns that happen in equity markets. Think of COVID as an example, right? During COVID, you suddenly saw a big drawdown in equities and a lot of people got scared and probably redeemed money at the exact wrong time. And this is where a hybrid fund, there are various types of hybrid funds, but if I have to generalize, this is where hybrid funds come into the picture, where the thought process is that through a combination of equity, fixed income, and gold in certain cases, you essentially get to a risk profile which is probably much more stable compared to investing in a 100% equity fund. And this is where a lot of people essentially, particularly if they are new to the whole mutual fund space, they essentially get a lot of comfort that at the end of the day, the risk profile measured in terms of drawdowns or corrections is not going to be that high in these hybrid funds. And this is achieved through a combination of investing in equities, fixed income, and gold in certain cases.
Okay, so at a time, Dinesh, just to follow up here, at a time when the market is at all-time highs, when there's so much equity participation, for someone who has a relatively higher risk profile and is perhaps in the age bracket of 30 to 40, out of, say, 100 rupees of an investment that he's making, how much should be in pure equities and how much you consider should be in these hybrid funds?
Yeah, no, frankly speaking, unfortunately, there is no, one solution for everyone, right? Because at the end of the day, it really boils down to what risk profile is that person comfortable with. Now, if someone truly believes in having a high risk profile and having a long enough time horizon, I would say that put all your money in equity funds because they are going to give you the most returns over a long enough time frame. But unfortunately, what we've seen is that a lot of people say that I have a high enough risk tolerance, but then when they actually see the correction, then they start panicking. And from that perspective, what we recommend is for many investors, have a core which is basically in the hybrid fund category. So call it like roughly 50% of your portfolio. 50% of your portfolio, you can essentially put in hybrid funds. These are supposed to be all-weather funds, which means that regardless of the exact market cycle, whether we are at the very peak or in mid-cycle or whatever it may be, you are probably going to generate returns much better than what you can get in a fixed deposit. I'm not saying that these funds are risk-free. They do carry risk, but the risk is definitely much lower than what you will see by investing in a pure equity fund.
Okay, got it. Bhavesh, after the indexation benefit removal, there was suddenly, a lot of attention, a lot of investor attraction that came into this category. Why do you think that is?
See, if you go back, the first change in debt taxation happened in 2014. Where NDA government in their first budget changed long-term capital gain tax of debt from from nothing to from 1 year to 3 years, and that was the time where actually hybrid as a category picked up. At that point of time, all arbitrage fund together was close to 5,000 crore. Today, that is the 1 lakh crore category. All balance fund put together was close to 35,000 crore. Today, that is almost a 2 lakh to 2,50,000 crore category. And now with this latest change, which has happened in this March, we have again seen the second round of uptick in the category, wherein people are looking to park their 3-year plus money, wherein earlier they were getting indexation benefit, and now that with that benefit taken away, people are trying to find out different places where they can park this money in a much efficient taxation. And that is where hybrid as a category has started picking up. Those who are purely looking at you can say, equal replacement are moving into arbitrage fund. That's why we have seen almost, say, 20,000, 25,000 crore of inflow into arbitrage fund in last 3 to 4 months. And those who are ready to take some risk are looking at fund like equity saving fund and balance advantage fund, wherein with some volatility they can get much better tax adjusted return over a 3 to 5 year time period.
Dinesh, comment on this, because I mean, there has been a lot of interest suddenly, right? If you look at the numbers, hybrid schemes have seen an inflow of over 14,000 crores just in the June quarter. I mean, this compares to an outflow in the preceding quarter. So is it purely because of the indexation benefits removal that you've seen this kind of money getting pumped in? And what do you see as the way forward over the next 1 to 2 years?
Yeah, definitely taxation does have a role to play. When you have essentially different taxation for different products, I think a lot of investors care about that. And from that perspective, it definitely has played a role. But more than that, what we are also witnessing is that there are many investors who historically have parked a significant part of their savings in FD-like products. And now they are realizing that you can essentially get much better returns without taking on like too much risk by investing in these hybrid funds. So from that perspective, there are a lot of first-time investors that we are seeing who are essentially slowly embarking their journey in the capital market space, and hybrid funds would be the perfect sort of stepping stone, so to speak, for a lot of these first-time investors.
Okay, so since we have a lot of first-time investors that watch our show, right, Bhavesh, for people who perhaps have never invested in hybrid schemes, what are the 2 or 3 reasons why they should do that, and how should they begin their journey?
Sure. So depending upon individual risk and return profile, one can look at different hybrid funds. Those who are very conservative and normally keep their money only into, say, bank account or maybe some liquid fund, they can start their journey with arbitrage fund, wherein everything is totally hedged. So even if Nifty goes up by 10-20% or goes down by 10-20%, they are not at a loss. They will keep on getting a better tax adjusted return compared to what they get in their saving account or maybe in their other fixed income fund. Those who are ready to take some risk, I think the first time investor, they should come into equity market purely into a fund like, say, balance advantage fund or equity saving fund, wherein a 3-year, 5-year down the line, he will get, you can say, a reasonable return, better than what normally a client will get in his fixed deposit or other, you can say, fixed income product with minimum volatility. I will not say that there is no volatility or no risk. There is risk, there is volatility, but compared to a pure equity fund, hybrid fund manages volatility in a much better way.
Okay. Dinesh, the hybrid funds since they invest both in equity and in debt schemes, right? One complaint is that there's a higher expense ratio compared to just investing in a pure debt fund. So if I anyway want to invest in both equities and debt, I invest in a pure equity fund and a pure debt fund, hence pay less expense ratio. But now with hybrid funds, the expense ratio is higher. You want to address that concern?
Yeah, I think where hybrid funds really come into the picture as a solution is the asset allocation part. Now, it's right. Someone can potentially sort of park part of their money in equity funds and remaining part of their money in debt funds. And potentially speaking, they should replicate what we are trying to do here, right? But the question is, how are you going to change asset allocation? Do you have a systematic way of changing asset allocation? And this is where a lot of people essentially sort of have problems. And this is where the hybrid funds as a solution really comes in. Because our job, number one job here, is to get asset allocation broadly right. Which means that when the odds are in favor of equities, when valuations are low and there is a lot of pessimism, we want to increase allocation to equities. And when we are at the other end of the spectrum, we actually want to reduce our allocation to equities and park more of the money in fixed income. And this is the job that we are trying to do, where we are trying to do in a systematic fashion. And what we've seen is the battle is more than half won if you are just doing it in a systematic way. It doesn't matter, frankly speaking, in terms of what exact approach you're using, as long as you're doing it in a systematic manner. And what we've seen is that for many investors, they don't have a systematic way of changing this asset allocation. And that is where the hybrid funds as a solution definitely comes in.
Okay, well, we have to take a short break. Both of you do, manage large hybrid funds. So after the break, I'm going to talk to you about that. Don't go anywhere. We'll be back in just a bit on Smart Money. Welcome back to Smart Money. We're doing a deep dive into hybrid funds and why it's a good thing to perhaps consider it as a part of your asset allocation, as a part of your core portfolio. We have with us Dinesh Balachandran of SBI Mutual Fund and Bhavesh Jain, the co-head hybrid solutions at Edelweiss Mutual Fund. Dinesh, let me come to you. We spoke a lot about hybrid funds and why people should look at it. You manage 2 hybrid funds at SBI Mutual Fund as well, which require moving between multiple asset classes, which is the SBI Balanced Advantage Fund and the Multi-Asset Allocation Fund. Now, can you tell us a little bit more about how you move through asset classes at a time like this, right, where there is a possibility of an interest rate cut beginning perhaps in the next few months from the US Fed? Equities are at an all-time high. Which are the asset classes that look good to you at the moment?
Yeah, so let me briefly walk you through the process behind the SBI Balanced Advantage Fund. The asset allocation framework for the SBI Balanced Advantage Fund is based on 3 factors: valuations, sentiment, and earnings. When we look at the valuations, so there we are comparing valuations of equities versus fixed income. And there we are clearly witnessing that equities look much more expensive compared to their historical averages and relative to fixed income. And from that perspective, if you have to just think about markets from a valuation perspective, clearly you would want to sort of be underweight equities at this point and be overweight fixed income. Now, but valuations do not explain it all. And that is where the sentiment piece and the earnings piece comes in. Market sentiment is an in-house proprietary index where we essentially track various factors, and we are broadly trying to gauge, are investors in general optimistic or pessimistic with respect to equity markets. And there what we are witnessing is that compared to March of this year, where investors looked a lot more pessimistic, clearly the needle has moved a lot towards the greed part of the spectrum, but it hasn't reached an extreme yet. So from that perspective, sentiment is bullish for equities, but it's not at an extreme level. And then the third part is the earnings part, where we are essentially seeing that there is a possibility of earnings deceleration going forward. So when you put it all together, our equity allocation at this point is 50%. So we have in a balanced advantage fund, we have 50% allocation to equities and 50% allocation to fixed income. And this is less than the neutral allocation. Under neutral circumstances, we would have 60% allocation to equity and 40% to fixed income. Clearly, because of the valuation part and the sentiment part and the earnings part, our current allocation is less than neutral.
Okay, what role does gold play in addition to equity and fixed income in this multi-asset allocation fund? I ask you because, gold prices are now at 60,000 rupees, and a lot of people missed out on this rally, right? And still want to sort of participate, but don't want to buy, say, sovereign gold bonds separately. How do they approach it?
Yeah, so this is where we have another fund, which is our SBI Multi-Asset Allocation Fund, where it is not just equity and fixed income, it is equity, fixed income, and gold. In my opinion, gold definitely is likely to play a non-trivial role going forward. Because when you think about last decade was one where it was broadly disinflationary. There were bouts of inflation, but they were just spikes, nothing more than that. But my suspicion is this decade is going to be a lot more about inflation. There is a non-zero probability that we might have a stagflationary-like scenario. And if you think about one asset class that does well in such a scenario, it's not equities, it is not fixed income, it is gold. And from that perspective, unlike what we saw in the last decade, where practically speaking, no one really needed gold, and gold actually didn't do well at all, right, broadly speaking. In my opinion, the situation is changing. And from that perspective, having a bit of gold in your portfolio is a perfect hedge for this stagflationary-like scenario, where I'm not saying that that will be the base case scenario, but it is a scenario that you don't want to completely wish away.
Okay. Do you agree with that, Bhavesh, that, this is a great way to perhaps get multiple assets in your portfolio and how are you positioned now, given that the market is sort of volatile, little bit volatile at this point in time, and we could be heading into a rate cutting cycle?
As Dinesh pointed out, they have a different model. Each balanced advantage fund have a different model. If you look the model which Edelweiss follow, which is Edelweiss Equity Health Index, our model is more on the basis of trend of market. Okay. And right now, equity trend is extremely positive. And that is the reason our balanced advantage fund today is running almost 70%, close to 70% equity, compared to there are other balanced advantage fund at 40 and 50% equity also. So as I told you, till the time, say different models have different way to, you can say, participate in this equity journey. Someone will be looking at valuation, someone will be looking at trend. But finally, it doesn't make any difference till the time we are able to solve the purpose of getting better risk-adjusted return over a, say, reasonable period of time. I think clients should continue to look into this category. Particularly today, when, say, on one hand, valuations look stretched. On the other hand, when you look at geopolitical situations between Ukraine, Russia, US, China, things are not that great. Again, inflation has started making, you can say, some uptick in India also. We see price of some of the vegetables. At the same time, crude is back to 85. So looking at all these things, I think it is still a time to stay invested in hybrid funds, wherein if this upside journey continues, we will be able to give you a decent participation. But if at all market takes a U-turn and we see a fall, we will be able to provide a decent protection compared to a normal equity fund.
Okay, Dinesh, there are aggressive hybrid funds and there are conservative hybrid funds, right? In this market cycle, what do you think retail investors should choose?
Yeah, like again, you don't want to have the same solution for everyone, right? And it's sort of a trite statement, but I think it really boils down to the risk profile of the investor.
So what is the difference, if you can explain to our viewers?
Yeah, if someone essentially has money in a fixed deposit and is sort of thinking that maybe I want a bit more returns, particularly on a tax-adjusted basis, but I do not want to see like a 10% correction in my investment, you know, where I don't want to see anything that looks like a double-digit kind of drawdown. For these investors, a conservative hybrid fund makes a lot of sense, because in a conservative hybrid fund, you probably are going to have somewhere in the 25% range allocation to equities. And the remaining will be in a combination of fixed income and arbitrage, depending on the fund. In such funds, the drawdown profile is not going to be very high. You will see some correction if the markets tank, but it is not going to be so significant. And so for investors who are very much worried about seeing a drawdown or a correction in their investment, they should start off by investing in a conservative hybrid fund. What is the trade-off? The return, while it will be higher than what you get in a fixed deposit product, is not going to be as high as what you might get in a more aggressive hybrid fund over a medium-term time frame. So always there is a trade-off. The higher return that you're likely to get in an aggressive hybrid fund comes with a higher risk profile. So the question someone has to ask themselves is, am I putting this money in for a shorter time frame, or am I putting this money in from a medium-term time frame? Medium to longer term time frame.
Sure.
Am I going to be worried when the markets tank and I am thinking about taking money out? Or am I going to say that, you know what, this is part and parcel of the journey. It's no big deal. I'm going to be okay. So once someone answers these questions, automatically the solution sort of presents itself.
Okay. We don't have too much time, so Bhavesh, let me end with you. What type of investors are investing in hybrid schemes? Who should invest in hybrid schemes? If you want to just wrap it up for us.
Yeah, again, very interesting question. But the main point is, it is not a tactical solution. I think hybrid should be part of each and every client's core portfolio. So a fresher who is coming into equity market for the first time, as well as a seasoned player who is there for last 15, 20 years, both of them have different kind of hybrid products which they can have in their portfolio. So those who are very conservative, there are funds like arbitrage fund, equity saving fund. Those who want to have different asset classes in their portfolio, then we have multi-asset allocation fund. And those who are looking to play, you can say, long-term equity journey, then we have fund like balance advantage fund and aggressive hybrid fund also. So it is a product which is suitable to each and every client depending on his risk and return profile. He can pick and choose which product he wants. Earlier, this category was very small and people used to think that it is just a parking instrument, and people used to look at hybrid only at the time of volatility or maybe a big rally. But now I'd say this category has proved time and again that it is no longer a tactical allocation. One can have at least 15, 20, 30% of his portfolio across hybrid fund at all point of time.
Okay, gentlemen, we've run out of time. Thanks a lot for joining us and explaining the do's and don'ts of hybrid funds. With that, it's a wrap on this edition of Smart Money. Have a great weekend.